All right, imagine you're driving your car. You hit the brakes, only to feel the car actually speed up. I mean, that sounds completely impossible, right? Well, for years, that's almost exactly what economists saw when they looked at data on the economy. Today, we're going to unravel this thing called the price puzzle by looking at a landmark 1994 paper by David Gordon and Eric Leeper that finally figured out what was really going on.
So it all starts with what seems like a pretty simple question. When a central bank, like the Fed here in the US, tries to guide the economy by changing interest rates, what's supposed to happen? You'd think there would be a pretty predictable answer. But, for a long, long time, the answer economists were getting from the data was, well, it was just plain bizarre.
In fact, some of the most respected studies out there were suggesting something that just feels totally backwards. They found that when the central bank would try to fight inflation by raising interest rates, prices would often, they'd go up. It really was like hitting the brakes and watching the car accelerate. It just made absolutely no sense. And this crazy result got a name, the price puzzle. It was one of several weird findings, or what they call anomalies, that had economists just scratching their heads. They had their theories about how the economy was supposed to work, but the real-world data seemed to be telling a completely different and very confusing story.
And this confusion wasn't just about prices. There was another key idea, something called the liquidity effect. The theory is pretty simple. If you pump more money into the banking system, short-term interest rates should go down. But when researchers looked at the data, that effect just seemed to be missing in action. It was almost like the textbooks were describing a totally different universe than the one we were actually living in.
But then, in 1994, a couple of economists, David Gordon and Eric Leeper, came along with a pretty radical new idea. They argued that maybe the economic theories weren't the problem at all. Maybe the researchers were just misreading the evidence. They called it a classic case of mistaken identity.
And this quote from their paper really gets right to the heart of it. What they were saying is that economists were making a huge mistake. They were confusing a symptom, which was the change in an interest rate, with the actual cause, which was the central bank's policy decision. They were just looking at one number and assuming it told them the whole story.
Okay, think about it like this. The old way of doing things saw an interest rate change and thought of it like someone just flipping a light switch. Simple, direct. But in the real world, it's way more complicated. An interest rate is just a price. It's the price of borrowing money. And like any price, it's set by this constant dance between supply and demand. The central bank has a huge influence on supply, no doubt, but the private sector creates the demand. So you can't just see the price move and automatically know who is leading the dance.
So what Gordon and Leeper proposed was actually a simple but totally revolutionary fix. They said, hey, let's stop looking at just one number. Instead, let's model the market for bank reserves just like any other market you learn about in your first economics class, with a good old-fashioned supply curve and a demand curve. Their whole model zeroed in on the market for bank reserves. In this market, the demand comes from private banks that need cash, while the supply, that's controlled by the central bank. And the interest rate, that's just the price where supply and demand meet. So the real trick was to figure out a way to separate a true policy change, a shift in supply, from a change in what the market itself was doing, a shift in demand. But how on earth could they do that using the same data that had confused everyone else? Well, they used this incredibly clever insight about information. See, the Fed can look at financial data like interest rates or commodity prices in real time, instantly. But the data on the real economy, stuff like inflation or unemployment numbers, that takes about a month to come in. And this simple timing difference, this information lag, that was the key that unlocked the entire puzzle. It let them finally tell the difference between the Fed's actions and the economy's reaction. And the results were, frankly, stunning. As soon as they applied this new supply and demand framework and could correctly identify the real policy actions, all of those strange anomalies that have been messing with the research for years, they just disappeared. So, just to recap, let's remember what that old, confusing picture looked like. The earlier models would see an interest rate hike, and then, for some reason, prices would start to go up. That was the infamous price puzzle, a result so weird it made people question if they understood anything at all. But with Gordon and Leeper's model, the picture became crystal clear. When they were able to isolate a true monetary tightening shock, a deliberate decision by the central bank to shrink the supply of money, the result was exactly what the textbooks always said it should be. Prices came down. Just like that, the puzzle was solved. And it wasn't only the price puzzle. All of a sudden, that missing liquidity effect popped right up in the data, loud and clear. When the Fed expanded the money supply, interest rates went down. Simple. And other key parts of the economy, like production and unemployment, also started responding in ways that were logical, significant, and perfectly in line with economic theory. It turns out the economic machine was working just fine after all.
Okay, so this is a really cool academic detective story, for sure. But why should this matter to the rest of us who aren't in economics departments? What's the real-world impact here?
Well, for one thing, the study found that these policy shocks were a surprisingly huge driver of the economy's constant ups and downs. Get this. Over a 2-year period, they found that these shocks accounted for over a third, 36% of all the swings in industrial production. We are not talking about some small, trivial effect here.
So this research was never just about fixing a theory in a textbook. It was about giving central bankers a much clearer, more accurate map of the economy they're trying to navigate. It gave them a new lens to see the real impact of their own decisions and to separate their actions from all the other noise out there in the system. And really, in the end, that's what this whole paper reminds us of. Making good policy isn't just about having good intentions. It's about having the right tools to actually understand the world. Because, let's be honest, if the map you're using is just flat out wrong, how can you ever hope to steer the ship in the right direction?